Hi, this is the toolkit, and I'd actually encourage you to read this table from the bottom up because the last two rows are what gets taught in every business school finance course, but honestly, they're mostly not accessible to you yet. Revolving credit facilities and asset based lending both require a financial track record and audited financials that most seed and Series A companies simply don't have. The top three rows, the ones I've marked as highly relevant for founders, are what you should know cold. Invoice financing and factoring. If you have receivables from credit-worthy customers, you can sell those invoices for cash today at a small discount. In India, trades platforms make this remarkably cheap and clean. I'll go deeper on that in just a moment. Venture debt, a non-dilutive loan from a specialized lender, usually sized against your last equity round. In the Indian market, names like Trifecta, Alteria, Stride Ventures, and Innoven are the main players. The right use of venture debt is to fund working capital growth between equity rounds, not to fund your operating losses. I've seen fintech and climate tech founders both misuse venture debt to plug burn instead of funding genuine WC growth, and it tends to catch up with them at the next fundraise conversation. Inventory financing, critical for D2C and e-commerce founders specifically. A lender advances capital against your purchased stock. Rates run higher than a straight bank facility, but they are far cheaper than burning the equity you raised at a 20 times multiple. The founder principle at the bottom of this slide is the one I want you to actually remember because I repeat it in almost every mandate I run. Financing your working capital with a dedicated, properly sized facility is always cheaper than financing it with your own equity or with an overdraft you didn't plan for. Everything we have covered so far applies globally. This slide is what makes the Indian market genuinely different. And in my experience, this single slide justifies the entire session for most Indian founders in the room. Lever 1. The MSME 45-day rule under Section 43BH of the Income Tax Act, effective April 2024. If you sell to enterprise customers and you're registered as a micro or small enterprise under Udyam, your buyers now have a real legal reason to pay you fast or lose their expense deduction until they actually pay you. Get yourself registered, it's free, and state your MSME status clearly on every invoice you raise. This is genuinely the single biggest DSO reduction lever Indian regulators have handed founders in a decade. The flip side matters too. If your own suppliers are MSMEs, you now have a legal 45-day cap on your DPO. Don't accidentally torch your own tax deductions by not knowing this. Lever 2. Threads. 3 RBI authorized platforms, RXIL, M1 Exchange, and InvoiceSmart. Enterprise invoices you'd normally wait 60 to 90 days on can be discounted in 24 to 72 hours, non-recourse, at roughly 8 to 11% per annum. This is genuinely the cheapest working capital an early stage Indian founder can access today. I worked on a B2B industrial services pitch where onboarding onto Threads for their top 3 enterprise clients converted what used to be 70 plus days of locked receivables into cash within 3 days of invoice generation. The impact on their reported CCC in the very next fundraise deck was dramatic, and investors noticed immediately. Lever 3, and the one founders consistently get wrong, GST input tax credit. I have reviewed balance sheets with 50 lakh rupees or more of accumulated ITC that the founder proudly presented as an asset. It mostly isn't unless you're exporting under a letter of undertaking or dealing with an inverted duty structure that ITC is not refundable. It only offsets against future output tax. And there's a sharper trap here. That credit must be reversed with interest if you don't pay your own supplier within 180 days. Model accumulated ITC in your cash forecast as tied up capital, not as a liquid asset. This single reframing changed the valuation conversation in more than one mandate I've run.